Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at signing day sports.
If you find our talks useful, please consider subscribe, like, and comment underneath. So imagine finding a stock, right? Valued at, well, under $10 million.
Yeah, a true microcap.
Exactly. But it is quietly building this, basically a monopoly on college athletic recruiting. And it just armed itself with $5.6 million in fresh cash to execute like a massive pivot into blockchain.
Which is, it's a fascinating convergence. You've got two massive industries that usually have absolutely nothing to do with one another.
Right. And if you're watching the markets right now, you know that finding a genuine edge means looking where the crowd hasn't caught on yet.
Totally.
So today, we are zeroing in on this wild, highly speculative setup that is currently flashing a massive 7 out of 10 bullish score.
It really is an unexpected intersection of high school sports and cryptographic technology. And the timing here is just critical for anyone tracking momentum.
Yeah, let's set the timeline for you listening, just so you have the exact context. Sure. Today is March 17, 2026.
Right.
And we are breaking down incredibly recent, high-volume market movements. This is all following a major shareholder vote that took place just a few days ago on March 13th.
Yep, that vote was the catalyst.
But, to understand why the stock is breaking out right now and to really grasp this blockchain pivot, we have to peel back the layers of the fundamental business first.
We have to know what the underlying asset actually is.
Exactly. So Signing Day Sports operates this digital ecosystem designed to connect student athletes with college coaches.
Which, honestly, if we stop right there, it sounds like a dozen other recruiting apps you could just download right now.
Yeah, generic scouting apps are everywhere.
Right, but the execution is the differentiator here. The core mechanism of their platform relies on what they call video-verified measurables.
Video-verified measurables, okay.
Yeah, they are building standardized profiles using really rigorous in-person skills assessments alongside academic data. And this isn't just, a software concept living on a cloud server somewhere. They are seeing heavy real-world traction by aggressively expanding into physical events.
So they aren't just an app, they're actually an event management operation too.
Basically, yeah. Consider the 2025 Military Appreciation Bowl National Combine they hosted.
Okay.
They pulled in nearly 1,000 participants for a single event.
Wait, think about the logistics of that for a second. 1,000 high school kids showing up to a single physical location.
It's massive.
You have to rent the stadium or like the practice facility, coordinate the staff, manage the insurance, run the drills, and then actually record the data for every single athlete.
Right.
That is a massive logistical mountain to climb. And they are expanding this model from their core sports, which are football and baseball, straight into basketball now.
Which obviously opens up an entirely new demographic of athletes.
Definitely.
And here is the operational detail that should make, any fundamental analyst sit up and take notice. This company runs on a 9-employee structure.
Wait, I have to stop you there. 9 employees total. Managing a national digital platform, building out a database, and hosting 1,000-person physical combines. How is that even mathematically possible without the entire operation just, catching on fire?
I know, it sounds crazy, but it's software leverage. It is an incredibly lean operation where the technology does all the heavy lifting.
So the automation handles the grunt work.
Exactly. The registration, the payment processing, the video clipping, the data sorting, it's all automated.
Wow.
They partner with local facilities and likely use contracted event staff for the specific combine days, to run the drills. But the actual corporate overhead is practically non-existent.
That's incredible.
Yeah. That drastically reduces their structural burn rate and accelerates their path to scalability.
Okay, well, let's get into the actual product, because this concept of video-verified measurables is super fascinating to me. It almost sounds like a verified blue check mark on social media.
Yes, that's exactly it.
But specifically engineered for high school athletes.
Yep.
But I have to play devil's advocate here for a minute. Anyone can upload a highlight tape to YouTube or Instagram for free. So how does this specific blue check mark actually create a switching cost?
That's the million-dollar question.
Why would a college coach trap themselves in this specific ecosystem when the internet is just full of free footage?
Imagine the daily reality of a Division I college football scout. Their inbox is a complete nightmare.
I can only imagine.
They receive thousands of emails, shaky smartphone videos shot through a chain link fence, and entirely self-reported statistics.
Right.
A kid emails them saying, he runs a 4.4-second 40-yard dash and stands 6'2".
But the coach has absolutely no idea if that dash was, like, hand-timed by the kid's uncle on a downhill slope, or if he's wearing boots to look taller. The data is entirely unreliable.
Exactly. And think about the financial risk of that unreliability. Imagine a university flying a coach across the country, putting them up in a hotel, spending thousands of dollars in recruiting budget because a kid's uploaded highlight reel looked incredible.
Oh, man, yeah.
The coach arrives, walks onto the high school field, and immediately realizes the kid is actually 5'9" and just used very clever camera angles.
That is a massive waste of time and institutional money.
Huge waste.
So the problem isn't a lack of data for these coaches. It's a lack of trust in the data.
Exactly. The platform solves the trust deficit because coaches can rely on centralized, standardized, and most importantly, verified data fed directly from exclusive in-person events like that combined.
Right.
And that creates an expanding, impenetrable moat. Sifting through unverified data costs universities real time and money. When Signing Day Sports provides a direct feed of trusted, standardized metrics, the athletic departments become completely reliant on it.
I see. So the more athletes attend these events to get their verified blue check mark, the more the coaches absolutely need to use the platform to find real talent.
Yes, it locks in users on both sides of the marketplace.
It's a closed loop. The physical events feed the secure data to the digital platform, and the digital platform's popularity makes attending the physical events mandatory for any high school athlete who actually wants to get recruited.
Precisely. You own the verification process, you own the market.
Wow.
It is the textbook definition of a network effect. But, running that network, especially the physical component, requires capital.
Which brings us to the most critical and arguably the most controversial piece of the puzzle, the financial health of the company.
Right, the financials.
Because renting stadiums for 1,000 athletes and expanding an entire vertical into basketball burns through cash fast. How does a microcap company fund this kind of ambitious growth without completely collapsing under a mountain of debt?
Well, let's look at the capitalization table. This is an emerging growth microcap. They only went public recently, back in November 2023.
Okay.
And their market cap has been tiny, fluctuating wildly between $1.98 million and $9.87 million.
Jeez.
And there are only 4.02 million shares outstanding. That is exceptionally small. You sneeze, and the market cap moves.
It is highly volatile, yeah. But the pivotal moment happened in January 2026. They executed a public offering that raised approximately $5.6 million in gross proceeds.
Okay.
And crucially, if you look at how this cash is being deployed, it is not being used to pay out dividends. It's not funding executive buybacks. It is earmarked purely for platform scaling and funding more of these regional combine events.
Okay, I am going to push back hard on the math here.
Go for it.
Because this is the exact scenario where retail investors historically get burned.
Yeah.
You just noted the company has been valued somewhere under $10 million, sometimes dipping as low as $2 million.
Yes.
And they just raised $5.6 million. That is massive, painful dilution for the existing shareholders. They practically printed an entirely new company's worth of shares.
It's a huge raise relative to their size, yeah.
Right. So why should you, as an investor trying to build wealth, view this massive cash grab as anything other than a glaring red flag?
Look, it is entirely fair to view dilution as a threat to shareholder value in a vacuum. I completely get that. But context is everything in microcap investing.
Okay, explain the context then.
For a company of this specific size, that capital isn't a cash grab to enrich the board. It is a critical lifeline. Without that cash, the moat we just talked about dries up completely. They stop hosting events, the coaches lose the data feed, and the network effect collapses.
Okay, so it was a matter of survival versus extinction.
Exactly.
But surviving isn't the same as thriving. Avoiding bankruptcy is great, but what are they actually doing with that $5 million to guarantee this isn't just a temporary Band-Aid?
They are using it to execute a highly specific turnaround strategy. Dilution is painful, but they essentially traded a few innings of equity to make sure they could afford to keep the stadium lights on for the rest of the game.
That's a good way to put it.
With the $5.6 million, they can finally monetize these large-scale events properly and successfully launch the basketball vertical without the immediate suffocating pressure of just trying to keep the lights on.
Right. breathing room.
Exactly. And because they raise this capital through equity rather than taking on massive institutional loans, their debt load remains incredibly low. It turns a severe survival risk into a tangible growth catalyst.
You know, that actually makes a lot of sense when you frame it around the debt load. You would much rather own a smaller percentage of a debt-free company that is actively dominating the college recruiting space
Exactly.
than a large percentage of a heavily indebted company that is one missed interest payment away from bankruptcy.
Right. And that fresh capital runway is exactly what set the stage for the massive transformative news from this past week, the catalyst that is currently driving the stock price higher.
Yeah, let's break down that catalyst. On March 13th, 2026, just a few days ago, stockholders officially approved a business combination with blockchain digital infrastructure, One Blockchain, and their affiliates.
Yep.
Then, right after the weekend, on March 16th, the company provided an official update on an expected ticker symbol transition.
And the market reacted immediately to the clarity. Shares are actively trading higher right now. We are seeing breakout momentum and the potential for gap-ups on the chart. When a merger is pending, there is always this dark cloud of overhang and doubt, right? The market hates uncertainty.
Oh, totally.
The March 13 vote removed a massive chunk of that doubt, and as a result, institutional interest and volume flow are noticeably elevated.
What's really strange, though, is how the algorithmic sentiment trackers are reading this. If you look at the quantitative sentiment scores for these specific news stories, like the merger approval, the ticker update, the algorithms are registering them as neutral.
Right.
They're just giving the news a flat score of 0.
Yeah, well, algorithmic sentiment often struggles with structural corporate actions. The scraping tools see administrative phrases like stockholder approval and ticker symbol transition, and they just code it as neutral corporate housekeeping.
They miss the nuance.
Exactly. They don't inherently understand the strategic value of the merger, but human buyers understand what this blockchain infrastructure actually means for the underlying business.
Right.
Plus, we have to factor in the broader market environment.
You mean the macro tailwinds?
Yes. We are currently seeing a heavy macro sector rotation into technology and software. Just recently, the NASDAQ was up 1.38%.
Okay, yeah.
That broader market appetite for tech provides a nice updraft for niche, tech-enabled platforms like this one. Institutional money is flowing back into speculative growth.
I understand the market mechanics, but I have to ask this with a very healthy dose of skepticism.
Let's hear.
Why on earth does a high school sports recruiting app need blockchain technology? Are they just slapping a trendy buzzword tech label onto their company to pump the stock price? Or is there an actual wealth-building utility here?
It's a fair question.
Because, I mean, we have all seen companies over the years pivot to blockchain or AI just to get a quick headline and a temporary volume spike.
Oh, absolutely. It is the single most important question an investor can ask in this scenario. Is it a gimmick or is it utility?
Right.
But if we break down the mechanics of this speculative catalyst, blockchain actually solves the final, most critical vulnerability in their business model: data security.
Okay, go back to the blue check mark analogy.
Right. We established earlier that coaches need to trust the data. But how does that physical data get onto the digital platform securely? In the tech world, this is known as the Oracle problem.
The Oracle problem.
Yeah. The blockchain itself is perfectly secure, but it is only as good as the physical data entered into it. That is why signing day sports physical combines are their secret weapon.
Oh, I see where you're going with this.
Imagine a high school kid running the 40-yard dash at the combine. He crosses the line, a laser timer records the speed, and an official combine employee enters that exact time into a tablet.
And here's where the blockchain comes in.
Yes. The moment that data is entered, it is cryptographically hashed to the blockchain ledger. It becomes immutable. It cannot be retroactively altered by an overzealous parent who hacked the account, or a high school coach trying to artificially inflate his program's stats to look better.
So once the measurable is recorded at the physical combine, it is locked on the digital ledger forever. It basically becomes an unhackable filing cabinet for athletic performance.
Exactly. It supercharges their existing moat. If signing day sports can guarantee to a major university that every single athlete profile on their platform is blockchain verified and mathematically tamper-proof.
It makes them the undeniable, absolute gold standard for college recruiters.
100%. These university athletic departments are handing out multi-million-dollar scholarships. They are making decisions that impact massive television revenue and coaching careers.
Right, the stakes are huge.
They cannot afford to make a mistake based on fraudulent stats.
Yeah.
Blockchain provides mathematical certainty in an industry that has historically relied on word-of-mouth rumors and stopwatches.
Wow, that completely reframes the entire narrative for me. It isn't about cryptocurrency or trading digital coins. It is about using the blockchain architecture as the ultimate infrastructure of trust.
Yes, utility.
And when you combine the $5.6 million in fresh capital to physically run the massive events with the blockchain infrastructure to secure the data generated from those events, you have an incredibly potent wealth-building combination.
The physical events generate the data, the blockchain secures the data, and the universities pay for access to the truth.
We have definitely outlined a highly bullish scenario here, but smart wealth building requires discipline. You always have to invert the thesis.
Always.
So what could go wrong right now? What is the bear case that listeners need to be aware of?
Well, the first major hurdle is execution risk. Mergers and ticker transitions are notoriously complex, both legally and operationally. Delays in closing the business combination or administrative hiccups with the stock exchanges regarding the new ticker symbol are very real threats. Going back to those neutral algorithmic sentiment scores, part of that flat score actually reflects lingering market uncertainty.
Oh.
The vote passed on March 13, but the legal ink still needs to dry, and the technological systems of these two entities still need to fully integrate.
And what about the actual business of generating revenue? Because when we look at the financial timeline, there is no specific earnings date on the calendar right now.
True.
We don't have specific revenue or earnings detailed in the latest August 2025 filings, and there isn't clear Q1 2026 guidance available yet either. We're essentially flying blind on their immediate day-to-day financials. Aren't investors just buying a story right now instead of a tangible cash-flowing business?
I mean, yeah, that is the inherent reality and the inherent risk of microcap investing. They are still in the very early stages in a highly fragmented, intensely competitive recruiting space. You are absolutely buying the future trajectory, not the current trailing earnings.
Right.
But we have to logically contextualize that risk against the valuation because the market cap is so incredibly low, sitting between $2 and $10 million. A significant amount of this early stage volatility and lack of profitability is already priced into the stock.
Yeah, the market isn't stupid. If this were a mature, highly profitable business with predictable quarterly earnings, it wouldn't be trading at a $5 million valuation.
Exactly.
It would be trading at 50 or 500 million.
The market has already discounted the execution risk, and this brings us right back to the importance of that capital raise. That $5.6 million cash runway fundamentally mitigates the short-term existential threat. They're not going to run out of money next month while trying to integrate this complex blockchain merger. That cash allows savvy investors to look past the lack of an immediate earnings per share beat and instead focus on the operational milestones.
So if you are actively watching this stock, you aren't necessarily refreshing your screen waiting for them to announce a massive profit in Q1.
No, not at all.
You are watching the physical combined attendance numbers. You are watching the rollout of the basketball vertical. And you are waiting for the final official confirmation that the new ticker is live and the blockchain infrastructure is fully integrated and functioning.
The barometers of success are operational and structural right now, not purely financial. You are tracking the building of the moat.
So what does this all mean when we bring the fundamental business, the financial runway, and the technical price action together? Let's give you the final, actionable wealth-building thesis.
Let's do it.
The elevator pitch for Signing Day Sports is basically this. You are looking at an explosive growth setup fueled by a network effect event ecosystem. That ecosystem is about to be technologically supercharged by an approved blockchain merger. And the entire operation is backed by $5.6 million in fresh capital to ensure they have runway to actually pull it off.
It entirely justifies that bullish score of 7 out of 10. The pieces are all positioned on the board, and the March 13 shareholder vote was the catalyst that officially put them in motion.
And in terms of a target horizon, how should you be viewing this from a portfolio perspective?
Well, this setup is perfectly positioned as a swing trade heading into the merger close over the next 1 to 3 months. That is where the immediate M&A clarity, the breakout momentum, and the elevated volume flow are pointing.
Okay, a swing trade.
But depending on your risk tolerance, there is also the potential to hold a core position for multi-year platform dominance, assuming they successfully secure that massive market share across high school football, baseball, and basketball.
It is the classic strategy of trading the immediate catalyst, but keeping a stake in the fundamental shift.
Exactly. If their blockchain integration successfully becomes the gold standard for college scouts, the long-term valuation of the company could completely decouple from its current microcap status.
Which leads me to one final provocative thought for you to mull over as you watch this exact scenario play out.
Oh, here we go.
We are living in a brand new era where name, image, and likeness NIL deals are completely reshaping the financial landscape of amateur sports.
Yes.
High school and college athletes are essentially becoming their own individual corporations, signing endorsement deals before they even step foot on a college campus.
It's wild.
As that trend accelerates and athletes monetize themselves, could an immutable, blockchain-verified athletic profile eventually become just as valuable and maybe even as tradable as the underlying stock of the platform hosting it?
Man, that is a fascinating financial frontier. When the athlete themselves becomes a tangible asset class, the platform verifying their data holds the absolute keys to the kingdom.
It is definitely something to keep front of mind as this ticker transition approaches. Keep your eyes on the volume flow, watch the operational execution of these upcoming basketball events, and always trust your own analysis. Until next time, keep building.